The number of places humans can safely live is now shrinking fast. The size of the board on which we can play the great game of human civilization is getting smaller. And that quote is from Bill McKibben, who's a longtime climate activist. And if you ponder that for a couple of minutes, you really start to understand the importance of climate.
Hello, everyone, and welcome back to Your Finance TV. Recording this on a Friday, so everyone knows what that means by this stage. We've got Jay Pelosky back. How are you, Jay?
Pretty good, Scott. Disappointing loss to Notre Dame last week, but a heck of a show, and feeling really good about the rest of the year.
Listen, I did see a fair bit of that game, and it was very, very exciting. I'm glad you got a chance to get down there to see it. But we're not here to talk about football today, Jay. We're here to talk about the market.
Hold on. What about your Aussie rules team, right? You guys had a big game.
Collingwood Magpies, yep. We did win the grand final last week at about 3:30 in the morning US time, Eastern Standard. It was a sensational game. They beat, God, I'm even blanking. They beat the Brisbane Lions by 4 points. It was an incredible game. But I have been celebrating that all week, even though I don't sound like I have been. But no, very, very exciting time for my family and my family back home. It's great to see them win. But once again, we're here to talk about markets, okay? And the title of your monthly is "Don't Get Swept Away." Now, I was thinking about this morning. There's so much bearishness out there, and all negativity. I've seen the press all this week. I think 99.9% of followers and people are all bearish, and then there is Mr. Pelosky, Mr. 0.1%.
Yeah, it feels that way. For sure. It's like, going on or watching Bloomberg, right, where they start their segments with just, 50 people basically saying the same word or two. It's like that's been the mentality. I mean, it's been so fast and so aggressive, and it's kind of hammered so many different assets that it really is easy to get swept away by all the negativity. And thus the title of the monthly, because this is a monthly, is, don't get swept away, right? We need to stand firm and really stick with our program, with our guideposts. And, we've been talking for the last several months about transition time and what gains traction during transition. And a couple of weeks ago, we talked about our 4 guideposts on the path to stability. And I really think, in a way, that the last couple of weeks has been another step towards stability. I know it's been a period of volatility, but really what we've seen is the bond market, and particularly the long end, reprice at warp speed to a world of higher for longer, a world of solid growth ahead, a world where earnings are going to be fine. And that's all good, right? That had to happen. The bond market, here's an important point. The bond market has been wrong for a while. It's been wrong about recession. It's been wrong about the Fed rate cut path. It's been in a deep bear market, probably the biggest and deepest bear market in U.S. Treasury history, or certainly going back over the last 50 plus years. And so do we really want to follow that as our, North Star for guidance about markets? We don't think so, right? So we're staying to the path. We think the best explanation for what's happened is not foreign selling, because the data doesn't support it. It's not too much supply. All of a sudden, the big deficit boogeyman has come back like with a vengeance, like a Halloween character. Auctions have been fine, right? You want to see what demand is? Look at the auctions, right? Fed Treasury auctions, money, bills, and notes all the time. Bid to cover is fine. Hedge funds piling on, that's probably a good explanation, right? Record short U.S. Treasuries. And then most importantly is this repricing of a different, more realistic, in our view, global growth path. And so to sum it all up, as long as that repricing does not create a crisis, and we don't think there is sign of a crisis, right? Credit market fine, banks are fine, consumer is fine. We just found out the consumer has more money than we thought it did, et cetera, et cetera. So as long as there's no crisis, then post this coming to reality lies that stability. And from overshoot lies opportunity. And I think we're seeing that even in the market action this morning, right? Big blowout jobs number. Bonds sold off aggressively 8:30, 9 o'clock this morning. And then, boom, we've had an epic reversal, right? Bonds have rallied. The dollar has sold off back under 106 on DXY, and stocks are up 0.75%. And that makes that supports the idea that a lot of this was hedge funds jumping on momentum trades and piling into shorts in the treasuries. As soon as they saw that the market wasn't breaking down beyond where it had been a couple of days ago, boom, that's it, right? You're short, you made a lot of money, you got to flip and cover, and that covering brings in some buying. So I think we're probably today probably marks the end of this cycle of carnage, and that reversal across assets, right? Because everything has kind of become connected. Usual diversification of one when people get confused and scared, right? So dollar, bonds, stocks, all kind of tied together, and all are extended, super extended. Stocks oversold, treasuries oversold, dollar overbought. Everything starts to unwind, and we go back in the other way. And guess what? Next week we have earnings. And if the Q3 GDP number from the Atlanta Fed nowcast, now saying around 4%, is anywhere close to being right, earnings are going to be fine. And then the outlook into 2024 is where we need to start paying attention. So the last thing that I wrote in my piece was stay the course. And that's what we're doing here at TPW Advisory.
Well, it's like, listen, I love the monthlies because you break it down so nicely for everyone. But obviously, there's a lot of investors a little bit panicky out there right now, obviously hearing all this negative news. You and I talked before we came on here, and we talked about routine and how it's good to have routine when things aren't really going the right way for you. There's a bit of panic floating out there. So you go through your routine, go through your steps to know that everything's working well. So let's stick with the routine of your rundown then and your monthly, and let's start with climate.
Yeah, exactly. Routines, habits in times of stress and uncertainty are really valuable, and certainly that's what we try to do here. Take advantage of all the experience we have over the years, and stay true to our routine. And just on that note, the monthly this month is a good lift. It's a great read, 6,000 words. So if it's raining this weekend, go to the website, Pelosky.com, pick it up, read it. We've got 26 charts and tables from over 19 different sources. So you get the whole picture from TPW Advisory. And we start with climate because climate is really critical. And in the climate section, we began with a quote, and let me just read it. The number of places humans can safely live is now shrinking fast. The size of the board on which we can play the great game of human civilization is getting smaller. And that quote is from Bill McKibben, who's a longtime climate activist. And if you ponder that for a couple of minutes, you really start to understand the importance of climate. And that's why we put it first in our routine of things we cover, before economics, before politics, before policy, because it is central in our view. Now, that obviously means that there's plenty to talk about, and we cover three things quickly here in the climate section. The first is the EV revolution, where we note that Chinese automakers, particularly BYD, are now challenging Tesla for a global production EV leader. And BYD is getting big in Europe. And by the way, it trades at 19 times forward earnings versus Tesla trading at 60 times. So another example of China being uber cheap. The second point we touch on is the gap between continued expansion of renewables, renewable power around the world, and the really poor performance of renewable stocks over the last couple of months in particular. And we go into a pretty deep dive on that, and we highlight the fact that we've been barbelled for the last couple of years between clean energy and fossil fuels. And we've talked about it, right? We own the oil companies, we own the carbon side of things, we own the EV stuff in particular. And so it's just really interesting. The business of renewables continues to expand, but the stock prices have really come in dramatically, in part because of investors' fear that, with 5% interest rates, a lot of the financing that was available 2 years ago may not be available in the future. And then the last point we make and we cover is what is looking to be a new bull market in uranium. And that has been the best position for us. Our URNM position has been the best for both of our models, our global multi-asset, or GMA, as well as our TPW20. And just as an illustration, the commercial inventories that currently are in place, the last time they were as low as they are today was in the mid-2000s, and uranium spiked to $145 a pound, okay? Today, it's at $45 a pound. Now, we're not saying that we're going to 150, but we're saying that 45 is probably not where this is going to end up. And so we're looking at this weakness in the markets over the last week or two has started to come into and hit things like uranium. And that to us looks like a really, really good opportunity in the climate sector.
Let's move on to economics. And obviously there's been a slew of data that's come out and there's more going ahead. And once again, we go back to the press, like sensationalizing all of this. It's a lot to take in, not just US, but globally as well. Like obviously China, like we've talked about China a lot. What are you seeing on the economics front?
Yeah, you're absolutely right, Scott. I mean, your head could be like whirling with all the different data points, pointing often in different directions, right? So we stick to our four guideposts, okay? One of the things that I think we do reasonably well at TPW is kind of synthesize a lot of the data and a lot of information and kind of put it in perspective. And so we really have been looking for the last month or two on what we call the four signposts on the road to stability, to macro stability, global macro stability. And so the first is continued disinflation in both the US and Europe, right? And we got the core PCE data last week, very compelling. And we think rents, which are now negative year over year in the United States, are going to support that continued disinflation in the US. In Europe's case, European CPI over Q3 was running at an annualized rate of 2.8%. So people still have in their mind that inflation in Europe is 6-7%. No. Q3 annualized 2.8%. And next month is going to be another month where year-over-year comps are going to be very, very easy. So we think as Europe moves into Q4 or into 2024 rather, that disinflation will continue there. We think both the Fed and the ECB are done raising rates. Second on the guidepost is the global manufacturing recovery. Here, there's just a ton of skepticism, but would note that the most recent ISM manufacturing PMI in the US came in much better than expected at 49. New orders were the best they've been in a couple of years. So manufacturing is coming back in the US. We think that number will break above the boom bust 50 line in the next couple of months. China, you mentioned China. China's manufacturing PMI came above 50 in September, first time since March. for that number to be above 50. And we think the European manufacturing, which is the weakest of the three regions, right, our Americas, Asia, Europe, the three regions of the tripolar world, we think Europe's manufacturing is bottoming as well. So the third signpost is continued rising earnings revisions. And there we'll get a lot more data in the next couple of weeks. But B of A has noted that their global earnings revision indicator has been at its best point since the spring of 2022, over the recent last couple of weeks. So we think earnings are a big support. One of the reasons why we've been consistently positive over the last year is because we believe earnings drive stock prices, and earnings have been fine. High nominal growth, right? Revenue growth at 6-8% allows for earnings growth to be somewhat decent. We expect that to continue. And then fourth and finally, the drips and drabs of Chinese policy stimulus actually starting to gain traction and support that, putting that economy onto a higher growth path. We feel really confident about China being able to show surprisingly strong economic data over the next couple of quarters, in large part because Q4 of last year and Q1 of this year were when Shanghai and other cities were under their most severe lockdowns. So in other words, the year-over-year comps are uber easy to beat. And by the way, the Golden Week, China's on holiday this week, the Golden Week data has been just really superb. We have a number of examples in the monthly where, data versus 2019, so not even versus 2022, 2019 is up 100%, up 75%. So, and you see it today, right? I mean, if you look at FXI, if you look at KWEB's up 3.5% today. China, by the way, outperformed the US in September, Chinese equity, outperformed S&P in September, outperformed the S&P in Q3. We're on record as saying that China is the single best global risk-reward trade between now and year end, and we continue to feel very strongly about that.
Let's move on to politics, shall we? And it always seems like a bit of a clown show on the politics side to me personally, but obviously you got the speaker issues this week. Trump's always in the press. Like, what do you make out of all of this noise, Jay? Because I listen, being a foreigner in your country, like, it's always a little bit of a laugh to me. But then I look at my politics back home; it's just about the same.
Yeah, no, I mean it's not pretty. What's interesting to me is that the world doesn't seem to care about the political machinations in the United States, right? And I say that because of the dollar, right? Dollar is up 12 weeks in a row. It's the strongest run for the dollar in the last decade or more. And amidst all this, clown show, I mean, that's the word I use as well in the piece. It's a clown show. And I think it's pretty amazing that this shutdown that was narrowly averted was all being driven by the far-right Republican caucus not wanting to provide any more aid to the Ukraine. And so I write in my piece that, Ronnie Reagan must be rolling over in his grave to see the Republican Party kind of become a party of appeasement to Russia and to Putin. So that's kind of where that sits. It just strikes me as just so interesting that, U.S. equity valuations are at a massive premium to the rest of the world. U.S. dollar, very overbought, very overvalued. The euro and yen are at like 40-year lows on a relative valuation basis. And yet, we have this political ridiculousness. The other, perhaps more important point is that it looks like President Xi and President Biden are going to meet next month at the APEC, Asia Pacific Economic Cooperation meeting. It's going to be held in San Francisco. This, I think, is pretty important because there's been, again, so much. I mean, the only thing where there's been more talk about, bad stuff than the bond market is U.S.-China relations, right? So the fact that President Xi and Biden are likely to meet, I think signals both sides want to kind of stabilize the situation. And I think that's really good, again, for our point of view on China risk being very, very appealing. Because look, China knows it's got to focus on its economy. It wants stability, right? It wants to provide an easy path for consumers to kind of come back to consuming, which typically post-COVID lockdowns takes a year. That year-end period ends this quarter, next quarter. So a lot of things are lining up for, a better look at China. And again, as we say, we're there, we're overweight. We think it's the single most compelling risk-reward trade across assets globally at this moment.
Okay, well, let's move on to policy. And you've already touched on it a bit there already, that you think that rate hikes are done. I think I saw the stat this morning at 29%. It's increased to a 29% chance of a rate hike coming up for the next meeting. That's still 71% chance of no. So,
yeah, numbers fluctuate. Look, the point we make is that that the difference between the Fed funds rate and core PCE, right? The Fed funds rate is now 150 basis points above the core PCE rate. And so that suggests to us, and not just us, and to others, that we have a very tight, very restrictive monetary policy. In fact, some would suggest it's the most restrictive since 2007. And that's not to suggest that what happened after 2007 is going to happen here, because we already talked about mortgage rates and the fact that they're fixed, not floating, which is what blew up in 2008. So not to say that that's coming, but simply to say that at this point, U.S. monetary policy is pretty tight, right? Real rates are at 15-year highs, right? The 10-year real rate, 2.3% or so. Again, 15-year highs back to that same 07 period. And so we think the real important thing is the shift in policy from monetary policy to fiscal policy, right? Monetary policy has been running the show since the great financial crisis. That ended with COVID, when fiscal policy took over and governments pretty much put everything, or not everything, but put a lot on the table to stabilize things for their citizens during a period of a global pandemic. So we're in the early phases of a shift away from monetary policy to fiscal policy. We think that's really the most important point. And that makes perfect sense to us because, again, we've been talking about the 3 C's of COVID, climate, and conflict. And to deal with the 3 C's and the aftermath of the 3 C's, you need government plus the private sector. And that's what's going to help drive the global economy forward, is that you have the public-private partnerships in the US with CHIPS Act, Infrastructure Act, IRA, in Europe with Next Gen, Fit for 55, etc. You have a more kind of refined policy approach in Japan and China, right? Neither of those countries opened the fiscal floodgates to stabilize things during COVID. Both have room now to continue to provide support. We expect, for example, a supplementary budget coming from Japan in the next couple of months. We expect in China continued support to provide the avenue for consumption to really pick up as China tries to rebalance its economy. So big picture policy-wise, not about fiscal, it's not about the Fed, it's not about monetary, it's about fiscal, it's about government, public-private partnership driving the deal with those 3 C's of COVID, climate, and conflict amidst a global manufacturing recovery and a CapEx boom.
Well, that all brings it right around to markets, right? And listen, markets have been difficult over the last week/2 weeks. But
yeah, I'd say for us even further, right? September, let's remember we've had 2 down months. We had the first negative quarter for ACWI and the S&P in about 5 quarters. So yeah, if you've been long only, which is we are at TPW Advisory, it's been pretty challenging. We have been overweight commodities. We have been completely out of the U.S. Treasury market for 2 years. So we've avoided the worst bear market in U.S. bond market history completely. We've been overweight commodities for much of this year. Commodities were the one thing that worked in Q3. So it's not all been bad, but it's been challenging. So we've talked about why we think we're approaching a reversal and why we're staying the course. Let's talk about one of the things we're getting interested in the bond market again. You haven't heard me say that since we've been working together. At these levels, you know what? I think the chances are pretty good for a rally in the 10-year Treasury. Not going to 5, but rather going back to 4.3, 4.5%, which would be a good 30 basis points here. If the 10-year real yield, which we just talked about, if it comes in a little bit, the correlation with the S&P has been very negative. So any kind of relief on the real yield front, which has gotten again very extended, will be very supportive of a risk asset rally. So we're thinking about bonds, U.S. Treasuries for the first time in a couple of years. That's interesting to us. We think in the U.S., things like financials, home builders, energy, all have been hit hard in the last couple of weeks. All are very cheap. We like all of them. We are overweight non-U.S. equity. So there we've talked about China, enough about China. Brazil and Mexico have been hit hard the last week or two. We like both markets. We think both are, certainly Brazil is a poster child for rate cutting in the emerging markets. And we think Mexico is the poster child for supply chain realignment. The biggest winner, probably globally, of supply chain realignment is Mexico. So opportunities presenting itself there. The real question is the dollar, right? The dollar has been like a wrecking ball, and we've touched on it a little bit, but it has been very aggressive. 12 weeks in a row of the dollar being up. The euro's been down 11 weeks in a row. It's the biggest sustained down move of the euro since it was formed in 1996. So we're talking, these are epic moves. And we think the dollar is pretty close to the end of its ascendancy here, particularly if we're right about the rates. If we're right that rates are going to roll over, that a lot of this the last week or so, action has been kind of hedge funds piling in, and now they're piling out. That sets up a rally in treasuries. That sets up a weaker dollar, right? Just look at the action today. Dollar is under 106. It was breaking through 107 2 days ago. So dollar rollover, that's really good for rest of world, really good for commodities. So we're watching that very carefully. And our bottom line is we think there's a really decent chance of an aggressive reversal in the trends of the last couple of weeks. So we are not sellers. We have not sold. We are holding firm, staying the course, watching our guideposts, sticking to our routines, and looking for opportunities where things have kind of been tossed out, baby with the bathwater style.
Great line to always finish on, throwing a baby out with the bathwater. All right, Jay, listen, thank you so much for this. A great breakdown on markets. You have a fantastic, restful weekend with Duke on a bite.
Yes, indeed. That's the plan, Scott. You have a good weekend as well, buddy. Great to see you. Thank you.
Thanks, Jay. And for everyone else out there, good luck investing.